Wonderful. Right, good morning, and welcome. Just trying to share this. Can you see my screen with the presentation?
Yes, but not presenter view, if that's what you were hoping to achieve.
That's presenter view now, yeah.
Correct. Yeah.
Fantastic. Okay, morning everyone. This is the 6th week in our 20-part series all about people who want to potentially look at selling their business and improve the valuation of the business beforehand. So just wanted to say this week is all about financial optimization. Financial optimization is clearly about making your business's money work smarter, not just harder. It's really is an art. It's like fine-tuning a car. So very small improvements can make a massive difference. And I'm really keen about this. I work with a company in Manchester who was an engineering company, and they were able to create increasing profit of 23% just by optimizing their payment terms and pricing structure. So in our series, we'll go through the 5 key things that it's really worthwhile looking at. We will have a chance for questions and answers at the end. So please feel free to put your questions in the chat box as we go through, and we'll pick them all up at the end of the 5 points. So the first one out of the 5 points is implementing strategies for improving profitability and cash flow. Over 80% of businesses that fail in the UK fail because of a lack of cash flow. So it's really important to make sure that you've got consistent cash in your business. I always like to think that there's enough money in the bank to be able to support the business running for 6 months. Particularly if you're a new business, or if you've just done some fundraising. Otherwise, hopefully today will give you some strategies that will be really helpful to help you make that cash go a little bit further. So the first thing I'd do in terms of increasing profitability and cash flow is looking at optimizing pricing strategies. So I very often go into businesses where they're simply not charging enough money. So I've been working with a company recently, and they're quite proud to be the best quality at the product that they produce, but one of the lower cost ones. That model doesn't really work because obviously having a really good quality product, theirs is an architect service. It costs a lot of money. So you need to make sure if you're going to offer the highest quality, and that's your USP, that you put your pricing up to result in it. The other thing that I often find is that people aren't pricing for allowing the pricing to reflect the amount of time and effort that goes into it. So when I worked in veterinary, for example, when I started in there, the pricing was very much based on the product cost rather than the service time. So we reduced all of the percentage margins on all of the products, and we started to charge properly for the vet and nurse and reception time, and for the use of the hospital, etc. So there's some simple things that you can do with your pricing. The inventory management is really important as well. I remember when I worked in corporate for Boots, there used to be a massive big warehouse with products that wouldn't move, and they'd go out of date in some cases beforehand. So it's really good to have some sort of simple inventory management system, even with an SME, to look at how long things have been in stock and to try to reduce those. It's also good to put in place just-in-time management processes. A lot of companies can now provide things in a day or two. So it's a great time to reflect on that. Look at the products that you have in, look at how long they're sitting with you, having already paid for them before they actually get shipped out if you have a product-based business. The other one is effective credit control and debt collection processes. We'll cover that in more detail on the fifth point. I just wanted to give another example, which is a business I work with in Birmingham, and they were a little service business doing web support. They were able to increase their cash flow by 25% just by getting better payment terms with the suppliers and implementing a just-in-time inventory system. So it's definitely something to think about. Now, the second point, if we move on, is streamlining in the financial reporting and forecasting processes. There's people on the call who are very experienced in finance, but just to say, this is one of the most important areas is financial reporting. Very often when I'm looking to buy businesses or I'm working with SMEs, there's just not a slick process for financial reporting. A lot of the financial measures are lagging measures. So you don't know necessarily, you can forecast it, but you don't necessarily know what your income is going to be and your profitability until after the fact. So it's really important to measure and track that frequently so that you can keep in touch with it. I was looking at Xero as an accounting system, and I really like Xero because it's a cloud accounting system. And it's really cheap. You can have a free version to start off with if money is tight, but it's good to put that process in place. They found last year in a survey that just putting a cloud reporting system in of any type can actually save about 15% of cost of financial admin and actually then impact and be 20% likely that you're going to have better cash flow. So it's definitely something to consider. You need robust financial forecasting models, and this is what I find very few SMEs have. But if you're looking to sell your business in the future, that's what people will be looking for. They'll be looking for 3 to 5 years of really good accounts that have gone past, but they'll also want to see that you understand and you've been planning as a business for future success, and that's where forecasting models come in. I find the easiest way to do that is to when you're starting out is to get help from a professional, but if you can't afford that, is to actually look at your profit and loss accounts and work with your team to say, let's look at our income. How can our income change? What can we do to change it? And then allow for the adjustments based on that. The important thing is getting a regular review and analysis of financial KPIs. A lot of businesses that I've worked with over the years spend so much time and concern about doing the reporting that they don't then take the time to sit back and look at those reports and actually see what they mean. So I think with finance in particular, it's about the trending. If your sales have gone up, why have they gone up? If they've gone down, why have they gone down? If your costs have increased in any particular area, why is that? And is there anything you can do about it? Now, we all know that since COVID and these crazy inflation, that supplier costs have gone up ridiculously. So have your own pricing as a business gone up to reflect that? Are you still making the same profit margin? So I would recommend once a month sitting down, looking at your sales, your profit, your expenses, and then looking at your cash flow and making sure that you've got enough cash coming into the business, including looking at your debtor days, the amount of money you've been owed and the amount you owe, and trying to regulate that. Again, we'll cover that a little bit more on the 5th slide. Like to give an example. There was a tech startup in Edinburgh, and they were able to reduce their financial reporting time by 50%, and they increased their forecast accuracy by 30% by putting in place a really good financial management software package. They started off with Xero actually, and they added it to it and used it more effectively. But they were also able to change their credit terms with both for their suppliers and their customers, which made a huge difference on that. Moving on to the third point, which is about your financial controls and processes. Now, it depends on the business. A lot of small businesses I work for, they have a sign-off process, so only they, as the entrepreneur owner, can actually sign off expenses. But that can creep, especially when your business gets bigger, and there's not a lot of clarity in terms of who signs off the expenses. I think as a entrepreneur owner of a business, you're often tied up with so many things that signing off basic expenses when your team increases in size can take up a lot of time and effort. So it's just getting a process in place so that you know that anything that's a small amount for a certain thing can be signed off by somebody else. You want to do a regular internal audit. So you want to make sure that all your finances are looked at and controlled. I worked for a big corporate, and I did a financial audit when I started as an operations director for them, and I found a hole in their accounts, which was a grey area on the profit and loss, which was overs and shorts. When I spent time looking at that, nobody could explain to me why there was a huge amount in that line. So we did a whole interrogation. We found that there was £250,000 missing. And the reason for that was it was for refunds, and there wasn't a refund process in place. So some people had been putting a refund through the till and had actually been taking money. We found a lady who'd taken £60,000 and put it in a saving account. It's just important to do those audits because you want to keep on top of things. It's very unlikely you'll have an issue like that, but just if you look and you query once a month with your accountant or with your finance team, it's amazing what you can find. And just make sure that you separate your financial duties to prevent fraud. There's a couple of FSMEs I've worked with recently where they've got a fantastic person working in finance, and they're really on board with it. But they've also got both companies have got a PA who is absolutely fantastic at financial understanding and awareness. So the PAs regularly go through and do a little bit of an audit run through and ask questions on the finances as well as the CEO, and it really helps to make sure that there's no holes or gaps and everything's accounted for. I work with SME in Leeds, and they did a new purchase order system, and that really helped them with regard to in combination, they also put in a regular financial monthly review, and that reduced unauthorized spending by 40%. They were quite a big company. They had about 100 people, and that's when it can go awry if you don't have systems and processes in place. Okay. Going on to the fourth point out of the five, it's optimizing your working capital. So this is one of my favorite areas because it can make such a big impact in how you work. I'm working with a business at the moment where they've got quite good cash flow, but they're prevented from doing some things, and they're cautious about bringing in more staff into business because the cash flow is reasonable, but it's not as good as it should be given the turnover of the business. So what we've done is we've looked at their accounts receivable and their accounts payable, and the money that they have owed by customers to their company is 62 debtor days, and yet they pay all their invoices by direct debit and standing orders, so they go out within 7 days. So they've got a massive big difference in days between the money going out and the money coming in, which is really impacting on their cash flow. So they're now going to work to make sure that there's a discount process in place to offer. They've changed their pricing, then put their pricing up to allow for this, but there's a 5% discount if the invoice is paid within 2 weeks. which will really make an impact on their cash flow. So there was, I just like to use statistics, and I was reading up about the Chartered Institute of Credit Management, and they found last year that most SMEs can free up £30,000 in cash flow by optimizing their capital management through this. So action points, if you haven't done so already for your business, is to negotiate better terms with your suppliers. That's making sure that you don't have to pay them necessarily by direct debit, or you pay them after 30 days by direct debit. See if you can manage that. And with your customers, it's absolutely fantastic if you get an opportunity with your customers to incentivize them to pay much sooner. Or indeed, I've worked with some businesses that will say, if the bill's not paid within 30 days, then we'll add an interest rate on for that. But the best thing to do is to work with your customers, if you've got a good relationship with them, or somebody in your team, and say, we're really keen to expand the business and to support you in different ways. We really need to manage our cash flow, and what can you do to pay quicker? What will help you to do that? It's incredible how flexible they can be. When I worked for I used to be a regional director for Halfords, and we were able to actually reduce the inventory massively, but more particularly our bills were paid afterwards rather than in advance. There was a process when I joined where we'd pay for stock and have to wait for it to come over from Europe, and instead we did it just in time, and we paid for it when we received it. So that made a massive difference. It works really well in wholesale as well. So I worked in Manchester with a wholesale distributor, and they improved their cash conversion cycle by 15 days by simply implementing early payment discounts for customers and negotiating extended payment terms with suppliers. So it's incredible what you can do to make a difference with your finances. And once you free up the finances, number one, it looks fantastic for your balance sheet, for your cash flow, and for prospective buyers. They will be much more interested in your business and want to pay more money. It will improve your profitability, and that will also improve the valuation of your business. And ultimately, when you go to sell your business, there's nothing more attractive than good cash management for potential buyers. The last one I want to cover today is exploring cost reduction opportunities without compromising quality. Now, it's very easy. I go in and help a lot of companies to turn around, and it's very easy to just cut costs and not look at the implications of it. So the first thing that I do when I go into a business, and you can do this in your own business quite easily, is to conduct a thorough cost analysis of all areas of the business. So where is your money going? Is it being accounted for? And is it are those costs rolling through to the pricing that you're charging your customers for your product or services? You then want to identify and eliminate non-value adding activities. So what are you doing or adding that's not making any difference to your team, to the quality of your product or service, and to the product or service from your customer's perspective? That might be things like, have you got an extra satellite office that since COVID nobody's really using, or they're not using very often? It could be, as I've worked with a couple of companies recently, they had an office for, one had an office for about 50 staff, one had an office for about 80 staff. Now they've got a hybrid model. They need much smaller offices. So they've been able to negotiate. They've got a long-term lease, both companies, but they were able to negotiate to change that lease to a much smaller space, and then pay a much smaller rent, so that it right-sized it to the hybrid way of working. Can you do that within your business? The other one is considering outsourcing non-core functions. Now, this is always an interesting one. I get asked this question all the time: is what should you outsource, what should you insource? It's a very difficult one to answer, because it really depends on your business and the size of your business, whether you're growing or not, and also the skills within your business. I always say, though, to entrepreneurs that they should consider outsourcing things that they're not expert on. So much as you'd should give work to your team on areas that you're not so comfortable with, if you're not great on a particular area, then consider outsourcing. So, for example, with myself, I will outsource my social media because I'm not very skilled on that. I can't. I don't want to have a full-time person working on that at the moment. So I outsource that to other businesses in the UK and abroad. So it's just something to consider. And from a tech perspective, do you want to outsource your tech? Probably a good idea if that's not your skill and you're relying on tech to support your business. But if you're actually a tech company, I work with a lot of health tech companies, then I would say that's a serious thing to ask about, because you want to make sure if you're developing tech to sell that you have the proprietary rights for that, and that's easier to do if you don't outsource. So those are the ones. In terms of cost reduction, I live just outside Bath. I work with a marketing agency in Bristol, just down the road, and they reduced their operational costs by 20% without affecting their service quality by moving to a hybrid way of working. And they also optimized their software subscriptions. They didn't need as many licenses as they had, and it saved them an awful lot of money. So we've covered a lot today in a short amount of time. We'll move on to questions in a minute. If you want to know anything more about any of those, we do have the Sales Success Circle, which provides literally hundreds of help and assessment guides. It will allow you to do a cost analysis on your business. It will allow you to do forecasting. We've got all the tools on there, and that's something that you can join free of charge. It's got different levels, but if you're looking at improving the finances in your business, or indeed looking to potentially sell your business either in the short or medium term, this is a great membership site with fantastic resources that you can get. So it's definitely worth looking at. We'll send you information on that after the presentation today. Okay, so that's where we finish the presentation today, but I'd like to take your questions. So does anyone have any questions today? Okay, I've got I do have some have come in from a couple of people who haven't been able to attend today. Just going to switch my light on. So the first one is relating to somebody who's looking to potentially sell their business. So their question is, when should they start making the financial tweaks if they're looking to sell their business soon? So my answer to that is how long is a piece of string? But realistically, to make the real substantial impact on the valuation of your business and the ease with it, which to sell it, you want to look at really improving your financial reporting and your financial management 2 to 3 years before you sell your business. The reason for that is that wearing my buyer hat, having been involved in over 50 acquisitions, I will always be keen to look at 3 years at least of financial history. So if I can see that the financial measures and the ratios are improving over that 3-year history, I want that company a lot more. So I'm going to be willing to pay more money for it. You also need enough time to show those improvements and show that there's a consistency in those improvements. That's why I'd suggest 2 or 3 years. It sometimes takes a while for major changes to be implemented without disrupting operations. So as an example, I work with a company in Yorkshire who are manufacturing, and they started to optimize their finances and their operations about 30 months before they actually sold. So they firstly streamlined operations and reduced costs. So we talked about that 2 weeks ago. Then they were able to enhance their profit margins and stabilize cash flow as a result of that. And finally, they spent the last few months leading up to the sale, actually while it was up for sale, fine-tuning and documenting their improvements. So there was like a playbook ready in place for anyone who was going to buy the business. As a result, they achieved a 40% higher valuation than initial estimates. That's one thing we do with Sales Success Circle is we have an amazing tool which is based on over 50,000 business sales. So if you want to find out more about the value of your business, I offer that as a free tool, a free service, so you can get a line in the sand for where you are. I've got one other question I'll cover in case, unless please do ask your questions if anyone's got questions. But this is a really interesting one. What's a common financial mistake sellers make, and how does it hurt the sale price? I would say the common mistake, and the one I find all the time when I'm looking for businesses to potentially buy, and when I'm working with people selling their business, is the amount of personal expenses that go through the business. You know, if you make a decision to put personal expenses, your kids' iPads and things through the business, that's absolutely fine. But when you actually go to value business, quite legitimately, the buyer will actually take the value of that and they'll adjust the EBITDA. So if you're working on an EBITDA profit multiple for your business, and your profit is only 100,000, and you're then looking to sell for 3 or 4 times that, if you've got £50,000 of personal expenses, holidays, cars, things like that, your profitability might drop to 50,000. So instead of getting 300,000 or 400,000 for your business, that you will potentially only get 1.5, 150,000. So it's definitely something to think about. Another question I have is about do financial optimizations vary based on the business size or industry? Oh yes, absolutely. That's definitely the case. You really need to tailor it to your specific situation. So the presentation I've given today is very much about generalization. That's why I've tried to give some examples. But for small businesses with a turnover of under about 2 million, I would say first thing to do is focus on cash flow management. It's really the most important thing to keep your business going and to make it more attractive when you do go to sell. The second one I'd probably do is work on supplier management and streamlining supplier payments so that you don't have to pay them as quickly. Very often we fall in a trap of doing direct debits, and we often pay before we use the service. So is there a way to push that back a little bit? And then I suppose the third one would be making sure that there's good financial controls in place. So again, just down the road in Bristol, I work with a plumbing company, and they had 45 days of debtor days. There were 45 when I started working with them. They were able to put measures in place by working with their customers to reduce that to 15. And it was only a small company, but that improved their cash flow by 50,000. So it's a really really important thing to do. Now, if you're a medium-sized business, maybe 2 to 10 million, that might be a little bit different. I would say your management reporting is the most important thing. You've got so many more people that need some responsibility and accountability for the numbers that they're bringing in. So financial reporting and managing people by what they deliver becomes more important. The other thing that's really important to do with a company that size is to optimize your working capital. You'll have a lot more working capital than in a smaller company. So you've got lots of decisions that you can make there to improve the size of the business, including potentially buying another business that's in a similar domain, because that can really increase your sales and profit very rapidly. And then you also, you're at that stage at 2 to 10 million that the business is a really good size, but you want to make sure that everything is scalable. So you've got processes in place, and trying to find them to be very easily repeated and consistent is probably important. So I hope that's been helpful. Any other questions? I think, Simon, you're the only one left now.
I am,
Anything?
it's just you and me.
Obviously, people didn't like the questions that came through.